Fed funds rate has a 40% chance of going meaningfully higher. We're not talking single digits here, right? We're almost a coin flip. I actually want to step through how we get there. Inflation's got to be higher than it is today, I think.
Rates are pretty much gone high enough. There's a lot of things that are not impacting the inflation numbers yet, like.
Alrighty, Mr. Jonathan Twomley. I don't know if you saw this, but the good old Jamie Dimon was once again talking, I think, out in India. And he put something out there that crossed my wire that the Fed funds rate has a 40% chance of going meaningfully higher. And he put a target on that of 7%.
7%.
7% Fed funds.
Doesn't talk
10 year.
I thought you meant 7% chance of it happening.
No, 40% chance.
Of 7%.
7% Fed funds rate, which is a significant number. We're not talking single digits here, right? We're almost a coin flip.
Yeah.
And what I want to talk about here is, sure, we can talk about what that might do, to commercial real estate, housing, economy, all of that. But I actually want to step through how we get there, because I think a lot of people are rotated around this idea of 7%, 10% mortgage rates, an economy doom and gloom. But I think there's a set of things that would need to happen over the next 90 to 3 to 6 months. So because they're out there, you and I could watch for it and we could see what's happened. I think most importantly, just for example, is inflation would have to meaningfully reaccelerate.
Yep.
Right. And not to say that going from 3 to 3.7 is not reacceleration, right? A lot of that was oil and all of that. But I think we would have to have inflation, hit 5% again. Not saying it's not possible. I'm just saying, hey, if we're going to get 10% mortgage rates, inflation's got to be higher than it is today, I think.
Yeah, I would agree with that. I think that's that's really like the thing to look out for, right? I mean, there may be other things to look out for, but I think the Fed has signaled that it's probably done. Like maybe there's another kind of small increase in store, but I think they've reached the point where they feel like, okay, the rates are pretty much gone high enough. They've pretty much whipped inflation. There's a lot of things that are still filtering through the data, right? That are not impacting the inflation numbers yet, like rents going down, right? So some of the rent increases or just the failure rent decreases or the failure to be increasing rapidly anymore. Still, from what I understand, has only just hit the numbers for inflation.
Just started.
So that will have a positive impact on the inflation numbers. And I don't think, frankly, that we're going to see any real big rent increases anytime soon. So I think that will be a stable number. So it's got to come from somewhere else. And where else could it come from? I mean, maybe oil and gas again, that could be a big one. But but unemployment is kind of cranking, right? I mean, so employment is already cranking. So I don't really anticipate employment going any higher than it is.
No.
Right.
So can't see it. Yeah.
And I don't know what the effects of like these strikes are going to have, in terms of raising wages enough to really impact, the inflation numbers. So I think that the Fed is very likely to kind of declare victory, even if we don't get down to the 2% target right away. I think what they will say is, hey, we've come a long way. We can kind of whittle this down slowly over time. I mean, if you remember back to, the 1980s, 1990s, when we had higher inflation, the target was 2% then as well. And it was a slow sort of grind down to get to 2%. And then we just went into this long period of time where we had very low inflation, part of it caused by the aftermath of the great financial crisis, which, we were still kind of floating through all the, outsourcing to China, all these things that kind of slowly, or that kept us under there. So I think they'll say, we're done, battle won, and absent some kind of, again, like some kind of big spike, I don't think that you'll see any major hikes.
Yeah, I think inflation certainly is the thing to watch again, and it's something we could watch certainly every month. and see if it's trending in a direction where 5% is possible, right? Because it doesn't feel possible today. But again, if Jamie Dimon's right, inflation will be the first thing we see. Other things I'll be watching is that services component, right? There is some wage inflation happening. Is it real? Is it nominal? Will it reaccelerate because it's coming in? I think there's other things, but I do think inflation is the number one thing. I think the other thing that would like to happen, and Jamie Dimon talked about this, is the flywheel of the U.S. economy has to keep cranking, and GDP growth has to be above trend. Again, certainly possible, but when you look at strikes and government shutdowns and student loans and consumer confidence cratering, and I don't know if you saw it this morning, but pending home sales down 7.1%. So again, the lag effect of the Fed increasing is starting to show up in the numbers. So I don't see any of the dominoes coming that would lead to 7%, but boy, it does produce a good headline.
Yeah, absolutely. I mean, and Jamie Dimon, like everyone else, likes to stay in the headlines, right? So,
yeah.
But I mean, look, he put it at below 50%, right? He's not saying it's toss up. He's saying it's a substantial possibility, but not even a probability. So, I think he's just putting it out there. It'll be interesting to see what happens, though. I mean, look, one of the things I don't know how much this affects the Fed per se, but around the world, central banks are having a harder time with inflation than we are, right? I mean, it's pretty persistent in Europe. I mean, England is having a heck of a time. I mean, a lot of that's them shooting themselves in the foot with Brexit, but they're having a much harder time whipping it, and they don't seem to have the stomach to raise rates as high as they need to really whip it, because their economy is also not doing so well right now. So I don't know if this affects how the Fed, what the Fed does, but it's just one of those things that's sort of out there that they're probably watching as well.
Oh, for sure. Yeah. Yeah. So when I think about the dominoes falling, I think that's what we should track. But, if we got to 7% funds rate, it would be no earlier than the summer of next year, because the Fed's not going to yank us there. There would have to be a series of events that get us there. But if we did in, I don't know, July or August of 24 at 7% Fed funds, the 10 years got to be at 6. And then, mortgage rates are 9 or 10%. And that would have a chilling effect on many. And I mean, cars. I mean, buying a car would have to be 15 or 16% to buy a car. So,
I mean, I wonder though, what we've seen, say, in the new home construction business is that people are buying down their interest rate, right? That's and the
builders actually doing it, but yeah,
right, yeah. I mean, well, they're offering people a way to buy down the interest rate, right? And I could see the auto manufacturers doing the same thing as well, right? Where if they, why not? Why couldn't they? I mean, we've seen this before. People forget, but I mean, we've definitely seen auto manufacturers have all kinds of incentives for people to buy, including favorable interest rates, lower down payments, whatever it takes to get people to buy automobiles. So, that could, I wouldn't be surprised to see that.
Yeah. Well, let's close this conversation out because we got 2 other meaty topics. What does Jonathan Twombly like to peg the chances of a 7% funds rate? Are you going to stick to the 40% like Jamie Dimon, or are you going to go something lower than that, or you don't want to play?
No, I'm going to go lower than that, honestly. I mean, I honestly think that we're entering a period of stable interest rates because I think that I see it as highly unlikely. I basically see like the Feds are trapped within a fairly narrow band of ability to move, right? They want to normalize interest rates, and they're not going to cut meaningfully absent a real economic calamity that forces their hand, and they're not going to raise meaningfully without the opposite happening, with inflation just spiking out of control. So I really see us entering into a period where interest rates, are sort of like fluctuating within a very narrow range for quite some time. Yeah,
that's exactly my call. Right. I think the Fed's done, and I think the Fed's, fast forward 18 months, they're going to be paused for the longest ever. I think the current longest pause is 11 months, and I really think it might be 18 months this time. So again, I think stable rates as well. Jonathan, where can people find you?
Yeah, so please come by to Apartment Investors Club. That's either on Facebook. Come join my Facebook group. Tell me you're from ORaaT. Love to have folks join me there. You can go to apartmentinvestorsclub.com and get my free download, or you can Google Two Bridges Asset Management, and I've got an active deal right now you might want to participate in. So if you're an accredited investor, I'd love to hear from you. I don't know when this is going to go up, but we actually have a webinar today at 1:30 p.m. Eastern.
Okay.
So if you come and find me, you can get on my email list and get the invitation.
1:30 Eastern.
1:30 Eastern.
I will try to get this up before then. Not sure I can, but I'll try.
There'll be a replay. There will be a replay.
Okay.
So if you get on my email list, you can get the replay after if you missed the webinar itself.
Awesome. Thanks, Jonathan.